Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month lead and tin. LME 3-month lead. The last of the big main drivers here since late spring and throughout the summer, as well as going into autumn and now winter, had been the construction of the June to date double bottom pattern. It is a lopsided double bottom, but is nevertheless still there. The market had most recently in December last year been scaling upwards on the second part of this double bottom. Prices looked like they managed to trigger it in early December, but in the end there was only a single close at the time over the key level, and the market bottled it. As I said 9 weeks ago, to justify such a pattern, and I quote, you would need at the very least prices to exceed and properly exceed the 50% Fibonacci line of the June to October 2018 move at 22.21, end of quote. In late December the market tried again and did make multiple attempts higher with good closes, but the daily patterns were very bitty, running into a fourth countering level and peaking with a shooting star pattern type 1 bearish 2 weeks ago before collapsing back down to a combination of supports that I will shortly detail. This now brings me to the recent pattern that has been dominating the action since late September. It is the late September to late October last year bullish shift pitchfork highlighted in purple on my daily chart. This bullish pitchfork has been pretty good, bar a couple of minor breaches. This is where I introduced the supports that have been seemingly very effectual in holding up this recent decline. First off, look at the lower time currently at 2072. Though this was breached, it had only the one close below and has seemingly repaired itself today by a big move up to the 50% Fibonacci line of the March 2020 to March 2022 move at 21.35. Next we have two moving averages, the slowly declining long moving average currently 20.83 and the rising medium moving average currently 20.63. Finally we have the January 2020 high at 20.39. That was approached but not tested. The questions now are pretty simple. Will these supports be enough to hold up the market in any renewed attempt lower? And will the 50% Fibonacci line at 21.35, will it be the cap to any recovery and possibly start a renewed attempt lower? Watch this space. LME 3-month tin. The story here since late June last year until the end of last year has been a series of stratified support levels that in late August became a series of stratified resistance levels, which have once again become a series of stratified support levels that the market has used to move higher out of the doldrums and into higher levels. The major ones below were and are at the following: between 23,000 and 24,155 at 21,360 and between 24.35 and 25.10. Since Christmas last year, this market has broken higher such that we are now testing the lesser Fibonacci line at 30.205. The real test is actually above and will now likely be the 50% Fibonacci line of the March 2020 to March 2022 move, a little higher at 31.845. We also now have the opportunity to have a November 2022 to date uptrend currently at 26,740 that I've drawn and highlighted in dark blue on my daily chart. Then there is the big thought I'd like to ponder again, if you will, which I spoke about last time, and I'd introduce an even bigger thought I'd like to share. So 9 weeks ago I said, and I quote, "The action since late August has caused me to think that perhaps the action is a possible descending scallop pattern. I'd like to see more on this to be sure, but right now it looks a lot like that to me. I'm minded therefore to give just a provisional idea on the upside for such a pattern, assuming of course it does not peak and revert back down, which would also be in line with this pattern. But for a continued move higher, you would have to look primarily in the 25.035 area and possibly later on, should it continue, up to 27.475. I am not ready as yet to start naming targets for this pattern, but it is worthwhile being prepared just in case, as I can easily discard these if they prove unsuitable." End of quote. They proved suitable, and this was the big thought I indicated, and I'm pleased to say that we have seen the market reach all the relevant targets for what I'm renaming now the small descending scallop pattern. Now comes the new bit, the even bigger bit. What if, and this is a big if, what if the action since March last year is part of a really, really, really big descending scallop pattern? In this pattern we have seen the move lower, and we now are on the upslope of the ski slope or inverted J pattern. Thus, if the rise does halt, and it may not be that soon, then perhaps, just perhaps, we can start measuring for a further big move lower or higher. The final thing I have to add is this. I have now an uptrend. If the market continues as it has done, then it is a reasonable expectation this uptrend may become part of a bull channel next time.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.